Welcome to Curious Commerce, Part 3 of Introduction to Financial Management. Today, we will discuss on the meaning of business finance. Business finance refers to money and credit employed in business. It is procured and utilized for business purpose. Business finance refers to the money and credit that a business needs to start, run, and grow. Every business, whether small or large, requires fund for day-to-day activities and long-term investments. Finance include all types of funds such as owners funds, borrowed funds, and internal funds. The amount of finance needed may change depending on the type of business, the size of the operations, and the business environment. Business finance is required continuously because the business must meet regular expenses and deal with unexpected situations. The simple examples: a bakery needs money to buy flour, sugar, ovens, and wages for the workers and pay electricity bill. All this money used in the bakery is called business finance. On the same way, for understanding purpose, Flipkart purchasing delivery vehicles, Infosys paying salaries to software engineers, Reliance starting a new oil refinery. On the base of the examples, so it is easy to understand business finance refers to money and credit employed in business. It is procured and utilized for business purpose. Significance of business finance. Why is finance important? Because every activity in business needs money. Finance is the lifeblood of business. Without sufficient funds, no business activity is possible. A company needs finance to acquire fixed assets like land, building, and machinery. It also needs money to purchase raw materials or goods for resale. Finance is essential to hire employees and pay their salaries. Finance need for day-to-day expenses of business. Businesses also need funds to adopt modern technology so they can compete in the market. Finance help companies manage unforeseen events. Finance helps for expand operations. Finance need for diversify product and take advantage of new business opportunities. Some practical examples. If you take the example of any e-commerce company, they need the huge finance to build warehouse, maintain delivery vehicles, and pay for their employees. Without the finance, it cannot deliver products to customer at proper time. And the same way, Tata Motors requires a huge fund to launch a new EV car. Zomato uses finance to pay delivery partners. TVS company needs money to buy raw material for their production activity or to produce the scooters. And the same way, small retail shop needs daily working capital for purchasing specific days stock. Relationship of finance with other disciplines. Finance does not work alone. It is closely connected with other business disciplines. Finance works together with all other departments of the organization. That's why finance and accounting work together for financial reporting, budgeting, and cost control. For example, for budget preparation by accountants helps finance manager take decisions. The second one is finance and economics. Finance and economics are connected because financial decisions depend on market demand, supply, price levels, and economic conditions, and all other macroeconomic factors. For example, RBI increases interest rate or fluctuations in interest rate affects loan decisions of the company. The third one is the finance and marketing. Finance and marketing work together because marketing decisions like pricing, advertising, and promotions requires financial planning. For example, to launch a new ad campaign or to market new product in the new market segment need the huge finance. For taking the decisions, the finance is essential. The fourth one is finance and human resource. Finance and human resource are linked because decisions about the employee salaries, recruitment, and training needs a proper financial budget. For example, if you consider any IT company needs finance to increase salary packages, same way they need the finance for the training the employees or for the knowledge transfer. Finance also uses mathematics, statistics, and quantitative techniques for forecasting, risk analysis, and decision making purpose. Finance and IT. Finance also uses information technology for digital payment and software for the operations of the finance department. That's why the finance has the good relationship with all the other disciplines like accounting, economics, marketing, human resource, mathematics, statistics, quantitative techniques, and information technology. Finance works together with all other departments. Theories of finance. The traditional theory of finance focuses mainly on profit maximization, procurement of fund for long term, and allocation of fund to the different department. This means The aim of the business is to earn as much profit as possible in short term. For example, a shopkeeper focuses only on daily profit. But in modern theory, focuses on wealth maximization, which means increasing the value of the company in the long run. Effective allocation and effective administrative of funds will take place in modern theory. For example, any XYZ company aims to increase shareholders' value for long term. Risk return trade off. Risk return trade off explains that if a company or an investor takes more risk, they expect to receive higher return. It means higher the risk, the expectation will be higher the return. Lower the risk, the expectation towards the return is also lower. For example, in the case of the stock, the investors or the investment management companies, if they take the higher risk, they expect the higher return. On the same way, if you deposit the money in the post office or in the bank, so your risk level is very low. That's why the return is also low. Generally, that the return level is not more than or equivalent to the inflation rate. The efficient market hypothesis states that the share price reflects all available information. So it is difficult to consistently outperform the market. For example, if any company announces good quarterly result or quarterly financial reports or certain information about the company, automatically the share price will be changes. Sometime it will be increase, sometime it will be decrease immediately. So that changes because of the information available in the market. It means that the efficient market means the market changes its direction only on the basis of the information. Financial management includes several important elements. It involves planning, how much finance the business will need. It includes budgeting and allocating funds to different departments. Another element is managing the capital structure, which means deciding the right mix of debt and equity. Financial management also involves managing working capital, which includes cash, inventory, and receivables. It means it is reporting. For example, a company must decide how much money to borrow from the bank and how much to raise through shareholders. And the same way, so which department needs how much money for the specific duration, for the specific quarter of financial year. On the same way, the financial manager expects certain reports from the reporting departments related to the capital or related to the cash maintenance or inventory or receivables. The major four key elements of financial management is the planning, allocating resources, managing performance and resources, and reporting.